This is Nightly Business Report with Tyler Matheson and Sue Herrera.
The rally that wasn't. The bounce back evaporates. A 440-point gain disappears as investors have a change of heart and sell intensely into the close. Off the sidelines, China makes a big move designed to reassure investors worldwide. And it worked, at least for a little while. Silver lining, as the market thrashes around, there's one important decision you may want to consider for your retirement money. All that and more tonight on Nightly Business Report for Tuesday, August 25th. Good evening, everyone, and welcome. I'm Sue Herrera. Tyler Matheson is off this evening. The rally vanished. The buyers ran away, and it was a reversal to remember as sellers came out in force, prompting a vicious sell-off in the final minutes of trading. The morning started out much different. The opening bell rang and stocks took off. The Dow Jones Industrial Average soaring as much as 440 points, staying elevated for much of the day thanks to a cut in interest rates by the Chinese government. But by late this afternoon, investors appeared less convinced, and the selling intensified, losing about 500 points in the final hour of trading. By the close, the blue chip Dow index finished lower by 205 points to 15,666. The Nasdaq was off 19, and the S&P 500 fell 25. The reversal in the Dow and the S&P was the biggest to the downside since the heart of the financial crisis. Bob Pisani has more on the rally that wasn't and why the bulls just couldn't hang on.
We had a rally at the open, but stocks lost steam midday and gains were wiped out in the last hour. So what's the problem? There was a nice rally at the open, but the buyers were never very enthusiastic. Volume was much lighter than yesterday throughout the day, but it picked up as the market drooped in the last hour. There were rebounds in a small group of tech leaders like Apple and Netflix, though they too were well off of their highs. But commodity and industrial stocks that have had the stuffing knocked out of them in the last few days should have bounced, but they never did. Copper maker Freeport-McMoRan, for example, is down 50% in 2 months, a 7-year low, but it still couldn't manage to do a rally. Pathetic. DuPont has also been in free fall for 3 months, and it still couldn't rally either. Big multinational companies that get a significant part of their earnings overseas, like GE, Ingersoll Rand, Illinois Tool Works, all faded at the close and ended down roughly 2%. What this tells me is that caution on global economic growth has not gone away, even with better than 10% declines in these big names in just a week's time. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Well, the early enthusiasm on Wall Street was sparked by China. That country cut interest rates again and flooded its banking system with cheap money in an effort to stem the rout in stocks. It is the 5th time in 9 months that the world's second largest economy has slashed rates. But for the Shanghai index, the damage was already done, falling another 7.5% overnight. Susan Lee in Hong Kong has the details.
After the Shanghai Composite crashed through 3,000 today, which is seen as a psychologically important level out here, China finally pulled the trigger. They had to do something, send a signal of confidence to the markets, because of the fact that they had stood still on the sidelines the last few trading sell-offs, where it really had the markets thinking maybe Beijing was happy to let market forces dictate. But no, they did cut interest rates tonight by 25 basis points. RRR, the reserves that banks have to hold aside, by 50 basis points, which ANZ says will free up $101 billion immediately into the Chinese financial system. Well, that could help lubricate the markets. And, China usually waits for Friday nights or weekends to cut interest rates or cut RRR. So the fact that they went ahead on a weekday, on this Tuesday evening, means that they want an immediate market impact. And we did see encouraging signs during the regular session. Some markets actually rallied despite the fact that Shanghai fell another 7.5%. We saw big gains in Australia, Taiwan, Malaysia, Indonesia, and more importantly, even the fact that Hong Kong actually ended up 0.75% higher, which is how foreign investors buy China. This is an encouraging sign that maybe a floor has been set. Maybe the buying has started once again. Goldman Sachs, for one, says that they are still remaining overweight on China when it comes to a valuation basis. Also, we need to keep things in context as well. Yes, China is down some 30% during the summer months, but the stock market is still up 50% over the past year. And some say, let's keep things in perspective and, not have tunnel vision. For Nightly Business Reports, I'm Susan Lee in Hong Kong.
Mark Lucchini joins us now to talk more about China and the rally that lost momentum on Wall Street. He is Chief Investment Strategist at Janney Montgomery. Nice to have you here, Mark. Welcome back to the program.
Thanks, Sue.
You were correct in predicting that the correction that we saw start last week isn't over yet, but I wonder whether this is just a correction or whether you think the bull market is over.
So we don't think the bull market's been derailed, even given the recent action that we've had. In fact, corrections are quite common in the market. Going back to 1980, for instance, we've seen no less than 19 times during which in the course of a year we've had a correction of 10% or more. And yet over that 35-year period, the annualized rate of return for the stock market on a price-only basis is 8.7%. So what we think is happening is investors are basically, given full valuations, are more demanding with regard to earnings growth expectations. And right now, those expectations are being disappointed by the prospects of weakening global growth.
What about China? Are you worried that China is not able to really stem the rout in its stock market? Do they have more room to be accommodative? What tools do they still have left?
Sure. I think it definitely warrants some caution with regard to what's happening there, obviously in terms of the size of their economy, but more important is really the blowback consequences to the emerging market complex at large, which collectively represents 52% of global GDP. So we're not immune from feeling the impact of China's situation continues to deteriorate. And I think they have plenty of scope from a policy perspective to continue to try to reflate economic activity. Yes, they've cut rates 5 times, as you said in your opening remarks, but the fact is at 18% on the reserve requirement ratio, still among the highest in the world today. Their overnight lending rate is still quite high when compared to other central bank policies around the world. So we continue to see plenty of full scope for them to continue to lower rates and or initiate some type of fiscal program, which I think they're reluctant to do, but all in an effort, if necessary, to at least arrest the slowdown in their economy.
So I would assume from what you just said that you do not think that what's happened in the last few days and weeks would lead to a global recession.
We don't. That's not our base case, Sue. We believe that they will ultimately be able to discover some level of growth that may be below the 7% print that we had for the second quarter, but well above what others are defining as a so-called hard landing. And as a consequence of that, in the context of other economies, the U.S., Euro area, Japan growing, we expect global growth to remain sturdy, if underwhelming.
What does this do for the Fed? I mean, the expectation has been that either in September or by the end of the year, we will see a move up in interest rates. Does the turmoil in the financial markets tie their hands?
Well, I mean, clearly you can see in the Fed futures the assigned probability to a liftoff in September and even in December have been taken down considerably. We're still of the view that they're likely to do something before year end. I think this may, in fact, jeopardize September, if only in the context of there's only about 3 weeks left of data accumulation that will allow for them to make a decision. And it's been complicated by recent events in China and elsewhere around the world. So that may push that off. But I think they're very eager to get off a zero bound because of the importance of the signal it means to the marketplace, which is the economy is sufficiently strong to warrant even so much as an 1/8 or perhaps a 1/4% interest rate hike.
All right, Mark, we'll leave it there. Thank you so much for your insights.
Thanks,
appreciate
Sue.
it. Mark Lucchini with Janney Montgomery Scott. And as we've been reporting, much of what's rattling the global markets is China and concerns about growth in that country and its steep market declines. So we wanted to see how the people of Beijing, who have money in that market, feel about the recent turmoil.
There's nothing to worry about since I'm used to this stock market drama. It's more that I have no confidence. I have no confidence with regards to the future of our capitalist market.
I can understand why investors are worried, but no one can save this unreasonable investment frenzy. It is not right to think that someone will be there to solve problems relating to bad investment choices.
I have confidence in our country's macroeconomic outlook.
The Shanghai Composite is down more than 40% from its peak in June. Boeing still has confidence in China. The Dow component raised its forecast for that country's aircraft demand over the next 20 years. The company expects China to buy more than 6,000 planes over the next 2 decades, and that estimate is higher than previous projections. BHP Billiton's CEO also expressing faith in the world's second largest economy. Despite reporting a nearly 90% drop in profits and cutting its long-term forecast for Chinese steel demand, the mining company's CEO says China's broader economy is on track and growth will hold up in the second half of the year.
We always said as a company that as China evolved, its growth would fall steadily from double digits, 7, and maybe even lower in the future. It's slightly slower growth, but at the same time, a transition towards more of a consumption-based economy is the right evolution that gives us faith that in the future they will be a major contributor to the world economy.
Today, shares of BHP rose more than 2% to $32.92. The plunge in oil prices has been another big concern for the markets, but today the buyers came back. Oil prices rose nearly 3% to settle at $39.31 a barrel, near a 6.5-year low. A bit later on the program, Morgan Brennan will report from the country's oil capital, Texas, to get a first-hand look at the ripple effects of this prolonged price downturn. Well, all the volatility in this market has got a lot of people wondering what it means for their retirement savings. And if you've looked at your 401k recently, you may feel a little rattled, but we have a silver lining perhaps. Sharon Epperson is here to tell us what it is. So what's the strategy here given the market correction? The silver lining, if you will.
The silver lining is really for retirement investors who have money in an IRA, a traditional IRA, or an old 401k. You can convert that money to a Roth IRA, and if it makes sense for you to do so based on your personal financial situation, the reason you want to do it now is because you've likely seen a decline in the value of those accounts, and you have to pay taxes on the tax-deferred accounts when you convert them to a Roth account. The beauty of a Roth account, of course, is that you're able to see that growth tax-free and withdraw earnings tax-free in retirement. But the key here is going to be to find money to pay taxes on this Roth account that's not from your retirement funds, and then be able to have that money tax-free when you need it for retirement.
All right, so that certainly sounds like a great silver lining. What if the market continues to fall and you lose more money in your Roth account?
So if that happens, or if you decide that, hey, this is not right for me at this particular time and I don't want to have a Roth account, you can actually undo it and you can turn it back into a traditional account, and you have until October 15th of next year to do that for any conversion that you do in 2015. So it's not you do it and then you have to have it forever. You do have a chance to change your mind.
Okay. Do you have to do it all in one lump sum, or can you do it a little bit at a time, or a portion of it?
So the beauty of this strategy, Sue, is that it's like any type of diversification. You want tax diversification as well as asset allocation diversification. And so you can just take a portion of an IRA or one IRA if you have several of them and convert that money. You don't have to convert it all at one time. You don't have to convert it all ever. So that's the thing to consider, that this is just a strategy that could perhaps help you if you're already in a situation where you're likely going to be in a higher tax bracket in retirement.
Right.
That's the ideal person that a Roth is right for. This might be a way to get some of that money tax-free in retirement while you have the tax-deferred accounts as well.
To kind of button this up, anything to watch out for? Any caveats on this?
Well, you do want to look at your tax situation. I mean, a lot of financial advisors say, hey, don't let the market drive what you do. Look at what your tax burden is going to be likely and see if this Roth account makes sense. That's probably the first thing you want to do. Talk to a professional, financial advisor, and an accountant.
All right. Thanks, Sharon, so much. Always appreciate it. Okay, still ahead, the housing market remains red hot, but is the recent market turmoil creating some headwinds for one of the key pillars of our economy? Consumers are feeling better than they have in 7 months. The Conference Board says its index jumped this month amid an improving labor market and lower gas prices. That survey, however, was taken before the global sell-off in the stock market. But analysts say that the outlook for consumption in the second half still remains strong. That improved labor market is also helping housing. Sales of newly built homes rose more than 5% in July, providing more evidence of continued strength in the housing market. And home prices also rose in June, according to the latest S&P Case-Shiller home price report. But as Diana Olick explains, all of that recent market volatility may be creating some headwinds for housing.
Sales of newly built homes moved higher in July, as did construction of new homes. Builders say they're seeing more buyers through models now, but they're not as bullish on the months ahead.
All during the summer from July to now, our traffic has been up and our sales have been up. And the only thing I can attribute it to is all the press about the Fed raising the discount rate in September. And the customer has to sign this.
But Mid-Atlantic's Stephen Paul also attributes his company's success to lowering prices.
We have gone down in size and in price to meet where the mortgage financing money is.
Now, with trouble in China's economy making a U.S. rate hike less likely, the outlook for housing in the back half of this year is less bright.
Something we've consistently heard from the home builders is that there's a lack of urgency among buyers, in part because rates haven't moved at all.
Demand for existing homes is already starting to fall as prices stay stubbornly high. And luxury home builder Toll Brothers fell short of earnings expectations as its average home price soared to a new high. Now, after a major kick to confidence in financial markets this week, some claim rates are taking a back seat to consumer caution.
It's hard to decouple that psychological effect of the wealth effect from the stock market. Even when you're not in it, you just feel better about it. You have that wealth effect. You feel like you have more credit, you have more prospects, income and wealth appreciation over time.
The thought just a week ago was that the Fed would raise rates this fall, and that could actually have given housing demand a boost, pushing some buyers off the fence and convincing others that the U.S. economy is improving enough to warrant buying a home. Now it seems like that scenario may be on hold. For Nightly Business Report, I'm Diana Olick in Washington.
Our next guest says the U.S. housing market is in a mixed but fragile state. He's Alan Weiss, founder of Weiss Residential Research. Alan, good to see you. Welcome back. Let's start. Why do you think it's fragile?
Well, what we're seeing is that while on average home prices are rising across the country, it's a very mixed bag. And in each of the strong markets, we're seeing the number of houses that are declining, increasing, and even more so in the weaker markets. So overall, I can't say that it's a strong market. I would say it's mixed.
So what do you think the impact will be of the last couple of weeks of market volatility, especially given what we saw in Monday's trading session?
Sure. Well, it's already a fragile market. It can't help at all. If anything, I think that this can shift the mood such that we'll see prices actually tipping down in several major markets across the country.
Where is the strength in the market? Which areas of the country or specific localities do you think could weather any potential financial storm better than others?
Well, certainly you see tremendous strength in San Francisco, in Denver, to a degree in Seattle. Those are very strong markets, whereas New York and Washington, D.C. in particular are rather weak. So if there is going to be a storm, I'd rather be on the West Coast.
I think in many of us would. What do you think investors should watch for at this point? Is it economic news? Is it continued market volatility? Is it the Fed moving on rates? What would be the one thing that would keep you awake at night?
Well, if we see housing prices across the board start to weaken further, that can have a ripple effect through the economy because of the wealth effect. I think up until recently, the reports have been essentially positive, which is something that holds the market up and holds the economy up. But if we see reports of declining prices in major markets and that continues, then the whole mood can change, and that can impact every aspect of the economy.
Now, the jury is still out about whether or not the Fed is going to raise rates, especially given the turmoil that we've seen. But what impact would, say, a quarter-point increase in rates have on the market that you just outlined?
Well, in housing, it ties directly into price because interest rates and mortgage rates obviously are the cornerstone of the cost structure of owning a home. So given that the prices have gone up enough such that we see weakness in many markets, I would say that any increase in rates can have a surprisingly large leveraged impact on the housing market.
Even though the Fed's been telegraphing for some time that they do want to raise rates, that's not already in the housing market, you don't think?
No, the housing market is not like the stock market. It's not very efficient. People make their move essentially for personal reasons, not reasons having to do with investments. It's not liquid. You can't get in and out of it. So I would say that that kind of impact moves slowly into the market in a very opposite way compared to the stock market, where you probably see excess volatility.
All right, we have to leave it there. Thank you, Alan. Alan Weiss with Weiss Residential Research. The budget deficit is expected to shrink. The Congressional Budget Office projects it will fall to $246 billion, the lowest level of the Obama presidency. That forecast is lower than the previous one in March, but the CBO also warned that Congress needs to take action on the budget, and if that doesn't happen, the trend will reverse. Best Buy was today's bright spot, and that's where we begin tonight's market focus. The retailer was the best performer in the S&P 500 after reporting an increase in earnings and revenue that beat estimates and a jump in same-store sales. Big screen TVs and phones continued to drive sales growth. Shares rose 12.5% to $32.95. Better sales of full-priced merchandise helped DSW post an increase in sales. But despite the rise, the retailer's top-line results didn't meet estimates. The firm backed its full-year earnings outlook. Still, shares tumbled more than 11% to $27.35. Also a disappointing quarter from Sanderson Farms. The poultry producer missed analysts' estimates on both the top and bottom lines, which it blamed on continued pricing pressure. The stock ended a fraction lower at $67.84. D.C. regulators rejected the proposed combination of power companies Exelon and Pepco. The deal had gotten the okay from surrounding states, but the nation's capital said the deal would not benefit ratepayers. Pepco slid 16.5% to $22.51. Exelon was off nearly 7% to $30.40. Oshkosh won a multi-billion-dollar contract, and under that contract, which would be worth more than $30 billion, the firm will build new tactical vehicles for the U.S. Marine Corps and Army. Shares rose in initial after-hours trading, and during the regular session, the stock was up 1.5% to $38.52. Coming up, how a Texas town at the center of the energy boom is handling the sharp and fast decline in oil prices. Here's a look at what to watch for tomorrow. A read on manufacturing with durable goods orders, more housing data with mortgage applications, and the market will be listening closely to hear from New York Fed President Bill Dudley. And that is what to watch on Wednesday. A former J.P. Morgan securities analyst and two of his friends have been arrested and charged for their involvement in an insider trading scheme that allegedly brought in more than $600,000 in illegal profits. The Securities and Exchange Commission says the analyst got sensitive information while working at the firm and then tipped off his friends. With crude oil prices below $40 a barrel and 58% lower than a year ago, the oil industry in Texas is feeling the strain. And no place is that more apparent, perhaps, than in Andrews, Texas, the town that has played a major role in America's oil revival. Morgan Brennan is there.
The prolonged price slump is taking its toll on oil towns like Midland, Texas. The metro area's July unemployment rate is still extremely low, 3.3%, but higher than the 2.1% rate at the end of 2014. Fewer workers in the energy sector, less money being spent in the local community. Midland's mayor, Jerry Morales, says the city, which revolves almost exclusively around oil, is reassessing its budget as tax revenue slows.
For all of 2014, we saw double-digit increases from the previous year, from 2013. Wow. So, that's unheard of. This year, we're seeing ourselves get back into the single digits.
Morales, a local restaurant owner himself, says business has softened. He's not experiencing long lines out the door like last year. Also, that home prices have fallen some 15 to 20%. But residents of Midland and other West Texas towns have seen these boom and bust cycles before, and everyone is taking steps to ride the downturn out. In the Permian Basin, production has continued to increase, just over 2 million barrels per day, according to the EIA. But the number of active rigs has dropped 55% since last September. By some estimates, an active rig can generate as many as 1,000 direct and indirect jobs. And one business park on the border of Midland and Odessa is storing nearly 40 inactive ones. If crude prices remain low, even rigs like this one that are drilling new wells may need to come offline. That's a possibility privately held producer Elevation Resources is currently contemplating.
It's not very exciting to put $7 million in the ground with the prospect of recovering that $7 million over 50 years. So this rig was put back to work when oil was $60 a barrel back in June. And with $40 a barrel, we have to reassess whether we can continue to justify running this drilling rig to drill new wells.
But there is a silver lining. Labor and equipment costs have come down significantly. And some producers like EXL Petroleum, which is cash flush from an asset sale last year, maintain there are still opportunities.
We are closing projects now. We're actually putting rigs back up in the air. We're fracking as we're talking. We're completing the wells we're speaking, and we'll be drilling. So it depends on when your company invested and how much you have invested. We're in good shape.
But expansion is certainly not the norm. There's a lag effect from prices falling to production cutting back. And here in West Texas, that takes about 6 months. Elevation Resources Pruitt expects production to slow through the rest of the year, with U.S. output likely down by 1 million barrels per day in early 2016. When prices begin to recover, more rigs will go up, and the cycle will begin again. For Nightly Business Report, I'm Morgan Brennan in Andrews, Texas.
And finally tonight, a child in a museum walking past $1 million masterpiece. A young Taiwanese boy tripped at the museum this weekend and caught his fall with a 350-year-old painting valued at roughly $1.5 million. The oil canvas called Flowers by Italian artist Paolo Porpora suffered a fist-sized hole. According to reports, the exhibition organizer, though, said the boy was not to blame and the painting was insured. Thank goodness for that. That's Nightly Business Report. I'm Sue Herrera. We'll see you tomorrow night. Thanks for joining us.